The stock market just hit another record. No friend.
Turn on any financial news channel right now and they'll celebrate. Confetti, smiling anchors, record highs. The S&P 500 is up. Everything looks wonderful. But here's a question nobody on TV is asking. What if the record high itself is the warning sign? Right now, U.S. large cap, mid cap, small cap, and international stocks are all near all-time highs. U.S. Bank on the surface, that sounds incredible. But history tells a very different story. And today, we're going to look at what history says, not what the headlines say. There's a market measurement called the CAPE ratio. Most people have never heard of it, but the smartest investors in the world watch it very carefully. The S&P 500 Shiller CAPE ratio compares the current price of the market to its inflation-adjusted earnings over the past 10 years. Historically, the average sits around 17, but throughout 2026, it's been hovering near 40. The motley fool, as of early May, the S&P 500 had a CAPE ratio of 39.6. Excluding the last few months, the index has not traded at such a high valuation since the dot-com crash in September 2000. The motley fool, you remember the dot-com crash. Trillions of dollars wiped out. Retirement accounts cut in half overnight. That is the last time we saw numbers like these. Now let's talk about the man who has been right about markets more than anyone alive, Warren Buffett. Berkshire Hathaway's cash pile hit $397.4 billion in the first quarter of 2026, a record. Buffett has not found prices compelling enough to deploy that cash at scale. The street, think about that. The greatest investor in American history is sitting on nearly $400 billion, not investing it. Buffett warned of a gambling mood in markets, saying that prices for many assets will look very silly in retrospect. In 60 years of investing, he found only 5 years genuinely worth acting aggressively. The street, when Warren Buffett refuses to buy, that is not a small thing. That is one of the loudest warning signals in investing. Now here's a risk that most American retirees are not connecting to their retirement accounts, and they should be. The S&P 500 fell sharply in March, when the Iran conflict pushed oil prices above $100 per barrel for the first time since 2022. The motley fool, the Iran conflict has pushed energy prices higher and disrupted global trade routes, which could keep inflation high if supply constraints persist. Crestwood Advisors, and here's why that directly threatens your savings. The Federal Reserve recently warned that inflationary pressure from an energy shock could force the central bank to raise interest rates, even if economic growth were to weaken. The motley fool, higher interest rates mean lower stock prices. It's that simple. And if you're retired or close to it, you may not have time to wait for a recovery. Let's talk about something that should worry every American over 65 right now, inflation and interest rates. March CPI came in at 3.3% year-over-year, accelerated from 2.4% in February, with headline CPI rising 0.9% month-over-month, driven by a 21.2% gasoline price surge. Crestwood Advisors, that means prices are going up, not down. And your retirement dollars buy less every single month. The yield on 10-year treasuries has continued to hover near 4.5%, historically a threshold for market distress. If benchmark long-term rates break higher, it could put further pressure on both stocks and the bond market. Fidelity, in plain English, both your stocks and your bonds could lose value at the same time. That is the nightmare scenario for retirees, and right now it is not off the table. So what do? Here is your calm, simple, practical plan, no panic required. Number 1, do not make sudden moves based on fear. Selling everything during uncertainty locks in your losses permanently. Number 2, check your portfolio balance between stocks and bonds. Investors may need to recalibrate expectations towards slower, bumpier growth as higher rates coexist with healthy corporate performance. Fidelity, talk to your advisor about whether your mix still fits your age and risk level. Number 3, keep some cash on hand. When the smartest investors in the world are holding cash, there is wisdom in that. Number 4, keep a long-term outlook. Regardless of whether a pullback occurs, healthy stocks will likely deliver positive total returns over time. The motley fool, the market going up is not always good news. But your job is not to predict the market. Your job is to protect what you've built. Stay informed, stay calm, and stay ahead.